Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest and one of my favorite guests. I actually started learning Austrian school economics from him back in 2007, 2008. He boldly went on business television and called a housing crisis while people were laughing at him. Well, guess what? 6, 12, 18 months later, he nailed the housing crisis. He was talking about the bailouts, the bank bailouts, the Federal Reserve Bank, monetizing debt and expanding its balance sheet. Seems like we're headed into even crazier times right now. We're recording this interview on Thursday, April 10th, 2025. Let me just get some market statistics first. The S&P 500 has been all over the place for the last couple of weeks. It's rallied a little bit to 5,200. The 10-year US Treasury yield has been an absolute roller coaster the last 3 months. After going down, it's rallied again up to 4.4% yield, and the gold price is just under $3,200. Today's special guest is a returning guest, like I said, chief economist and global strategist at Euro Pacific Capital, founder of Schiff Gold, a host of Schiff Radio, and New York Times bestselling author, including books like How Economy Grows and Why It Crashes, book on Austrian school economics and investing there. Peter Schiff, thank you for joining me.
Thanks, Jason, for having me on. Quite a day, quite a day.
And I wanted to give you the full intro there. You've accomplished a lot in your career. I mean, you have some amazing market calls over the years with the stock market crash. I mean, people literally did not believe that their housing prices could go down. It seems we're headed towards another train wreck in the not too distant future.
Yeah, I mean, actually, it's already started. And I've been saying now for several weeks that this reminds me more of 2008, just before the crisis, than any other period of my life, in that we are on the precipice of something much worse than 2008 by an order of magnitude. And nobody sees it coming, especially the Republicans. The Republicans, were blinded to it because Bush was president. And as far as they were concerned, the economy was great. And, they called me Dr. Doom for predicting this financial crisis. Well, the crisis we're about to have is going to be much worse. And unlike 2008, there's no bailouts, because the 2008 crisis was in private credit, in the mortgage market. This is in sovereign credit, the Treasury market. US Treasury bonds and the dollar are going to be the epicenter of the crisis. And when Treasuries go, they take the whole bond complex down with it. So this is a major economic crisis that has already begun. Right? We've already lost the trade war. It's just that Trump and his advisors don't realize that yet.
So by losing the trade war, do you mean that Trump and his advisors are trying to force a messy divorce with these escalating tariffs and countermeasures? Seems like almost every day there's press releases announcing, oh, we're going to do tariffs on this, or we're going to ban these goods, those types of things.
No, I mean, we may succeed in getting a divorce. That's the problem. We're the stay-at-home spouse that doesn't have any earning capacity. We've been living off the rest of the world. And if we get divorced with no alimony and no child support, we're screwed. Because Donald Trump doesn't understand, and neither do his advisors. The world is not screwing us. The world is not taking advantage of us. It's the other way around. We've got the world producing the goods that we can't. And we've got the world lending us the money that we don't save. So for a couple of decades now, we've been living off the rest of the world. The Fed creates inflation so that we can finance government deficits. And the people take the money that we create and they go shopping overseas. If they couldn't do that, if they had to spend their money here in America, prices would go through the roof. But instead, we send our money to Asia and other places, and they send us their goods. So we ship out our inflation and we import real stuff. Now our trading partners take the money they earned and they buy our bonds, they buy our stocks. So they give us a high stock market and low interest rates. So that's what keeps the whole bubble economy going. Trump wants to end the trade deficits. Okay, why do we have trade deficits? It's not because the rest of the world cheats or because they have tariffs. It's because we spend too much and save too little. We consume too much and produce too little. So if the trade deficits go away, we're stuck with our money, but no goods to buy. Prices go through the roof. In addition to the tariffs that we have to pay, Trump doesn't realize that the tariffs are on Americans. He can't tariff China. He tariffs Americans if they buy Chinese products, which we buy because that's what we got. But so our money's going to stay here, bidding up prices. But foreigners aren't going to earn dollars to buy treasuries. And so we get lower financial assets. So what Trump has just set into motion is skyrocketing consumer prices and collapsing asset prices. So everything Americans own is going to be less valuable, but everything we need to buy is going to be more expensive. And what China is already doing as they de-dollarize, and that's why gold was up over $90 today to a record high, on top of the $100 it gained yesterday, and why gold stocks are now hitting 52-week highs. Not only is China buying gold, they're buying euros. And they're selling treasuries and they're buying bunds. So the dollar had one of its worst days ever today. It dropped 2.25% against the euro and the yen. It dropped almost 4% against the Swiss franc in one day. As treasuries were collapsing and yields were spiking, as U.S. stocks were going down. I mean, there is a major exodus out of U.S. assets. So the tariffs already are producing the opposite effect of what Trump expected. He thought by putting on tariffs, capital would come into the United States. Instead, it's fleeing the United States. It's a mass exodus of capital. But I think the reason that China is buying up euros and bunds is because China sees the European Union as a replacement market for the United States. So, and this is going to be a great relationship for Europe, because Europe now needs to borrow more money to build up their own defense because we don't want to defend them anymore. So they have to sell a lot of bonds. Well, now China can lend them the money because they're going to take it away from America and they'll lend it to Europe. And as they're buying euros, the euro goes up. And that means now more Europeans are richer. They have more purchasing power and they can buy all the goods that China no longer sells to America. So Europe is going to get our credit. Europe is going to get China's credit, and they're going to get China's goods. And we're stuck with nothing. So this is a major collapse. We're going to have a financial crisis because rates are going to soar. We're going to have defaults, bankruptcies, and it's all happening now. It may not happen this week. It's going to take weeks or months to really work through the system. Now, the Fed is going to come in at some point and try to stop it all with rate cuts and QE. So that might buy us a few more weeks or a little bit, a couple more months. Who the hell knows? But that's going to unleash massive inflation. And it's not going to work the way it worked after the 2008 financial crisis.
It sounds like you've laid out the case, Peter, that the main holders of U.S. Treasuries in the past, whether that's China, Japan, or the European Union countries, they're going to be net sellers for different reasons, whether it's defending their own currency or they just don't like the policies out of D.C.
Well, their currencies are rising right now, but they want to get rid of dollars because why hold them? What's the point? What's the point of holding treasuries? The yields are too low. Our inflation is going to go through the roof. If you hold treasuries, you're just going to lose a bunch of money. So might as well get rid of them. I mean, buy gold. Gold goes up every day. So if you have treasuries, you can't buy gold. This is going to be a run on U.S. dollars and U.S. treasuries because Trump said, we want to rebalance global trade. Okay. That means Americans stop consuming, because that's the only way to get rid of the deficits. We have to stop buying stuff. But our whole economy is based on buying stuff and borrowing money to pay for it. But when the economy collapses because we're not getting imports anymore, we can't repay our bills. What's going to happen? We're going to have a wave of retailers going out of business, shutting down their stores because there's nothing to sell, right? And so
or the customers can't afford, or the customers, Peter, can't afford the higher prices. I mean, we're starting to see that too.
Yeah, no, the people are priced out of the market. So you're going to have all these defaults on commercial real estate loans. But the banks are all insolvent anyway because they have a bunch of treasuries. They own a bunch of mortgages. What's going to happen when the yield on a 10-year treasury is 8%, 10%? What are these banks worth? The Federal Reserve never stress tested any banks for a recession with rising interest rates. They always assume that if we have a recession, interest rates go down. Well, this recession is going to be different because interest rates are going to go way up. And the main reason the Federal Reserve never tested banks for that, other than the fact that they never thought it could happen, is that they knew that every bank would fail. And so all of our banks are insolvent and they're going to fail. unless the Fed bails them out. But where's the Fed going to bail them out? By printing worthless money? So, we could be looking at a sovereign debt crisis and a currency crisis. And so the magnitude of what's in front of us dwarfs anything that we experienced in 2008.
Now, this trade deficit that Trump has warned about, do you think that this is intentionally because of Triffin's dilemma and the U.S. abusing the world reserve currency for so many decades that they took it for granted and they just thought, the people in D.C. thought, and many companies and Wall Street just thought, we're just going to forever hold the world's reserve currency. We're just always, everyone's going to take the dollar. People are going to recycle into treasuries, like you were saying, with trade surpluses. Do you think that attitude caused just absolutely insane structural imbalances in the global economy?
Yeah, I mean, we definitely exploited the reserve status of the dollar. The trade deficits are not the problem. They're the symptom of the problem. It's because we've relied on the reserve status of the dollar to not produce, to import instead of producing. Because to produce, that's the hard work. You need to have the factories, the supply chains, the infrastructure. You have to deal with the pollution. You have to save money to cover the capital expenses. We don't do all that. We get all that for nothing. And then we have a service sector economy and we run these huge deficits and no one has to save. And everybody buys now and pays later. This whole bubble economy was just pricked by Trump. Now, it was going to collapse eventually anyway. In fact, a collapse is long overdue. We have succeeded for a long time in kicking the can down the road. I always thought years ago that it would be foreigners that would pull the plug on us. I didn't realize we'd pull it on ourselves, but that's what happened.
It kind of reminds me, Peter, I know you've read The Great Depression and you've written books about it and talked about it many times in your podcast. It kind of reminds me of hearing a lot of the same policies of Herbert Hoover, because Herbert Hoover had a successful private sector business track record. He started adopting Keynesian economics rapidly as soon as it was just a theory and started coming out. And then he started putting on a ton of tariffs, a ton of subsidies to domestic, farmers and manufacturers. We're seeing a lot of the same stuff because the business owners I see go on TV, Peter, small business owners, the benefits of the trade war and the tariffs, they're saying that, we're going to get a subsidy. It's just kind of shocking how history seems to be repeating.
Yeah. And then he ran big deficits and he was trying to stimulate and he was trying to encourage employers, not to lay off their workers or not to cut their wages, even though prices were collapsing by 30%. He said, don't cut wages. So instead of cutting wages, they laid people off. Look, Hoover was the most interventionist president up until, his presidency. And ironically, Roosevelt ran against Hoover, promising to balance the budgets that he ran up the debt. But Roosevelt just expanded Hoover's policies and made the Great Depression great. But Hoover did a lot of damage to the Republican brand. And it took decades and decades to recover. So Trump could be even worse for the Republicans than Hoover was, because everything is going to be blamed on Trump. Trump did not inflate this bubble. I mean, yes, he did his part for the 4 years he was president. More air went into it, but he just popped it. But again, it was going to pop eventually. But because he did it, the Democrats are going to say everything was great and he destroyed it, right?
Well, they're trying to blame inflation.
The public is going to believe that. It's going to make sense to the public that that's what happened.
Well, he was only in office for about a month, 6 weeks, and they were trying to blame all the inflation for years on him. But unfortunately, this is what both political parties do.
Right. But since he imposes the tariffs, right, and then there's immediate collapse, they're going to be able to say the tariffs did it. Also, he had a lot of cuts to, Doge, and they overblew because there really aren't big cuts going on. They're just talking about it. But they're going to say Trump came in and disrupted the government with Doge, fired a bunch of people, launched a trade war, destroyed the economy. Right? And they're going to say, look how quick. It only took them a few months to completely destroy the entire economy. And, because Trump never prepared anybody for this, he overpromised. He said, vote for me and it's going to be a boom. You're going to be richer than you've ever been. It's going to be Morning in America times 10. It's a new golden age of America. And so he promises this huge boom and he delivers the biggest bust ever. So how is he going to get out from under that? He's not going to be able to say, yeah, this is all part of my plan, like he's trying to do with the tariffs. trying to claim that, yeah, this is exactly what I wanted. They fell into my trap. He's making excuses for failure, but he's not going to be able to make an excuse for this failure because it's going to be monumental.
It also seems, Peter, like the tariffs and the subsidies, they're not free market policies. They're just more central planning, more interventionist, and they're going to be picking winners and losers. So if the entity gets hurt by the small business owner industry gets hurt by the tariffs, but they don't get a subsidy, they could potentially go bankrupt. We're going to see the average regular person, the middle class consumer, their standard of living is probably going to go down enormously. Now, maybe some of these factory jobs will come back, but even the Trump administration people on business TV, Peter, they're saying even if the factories come back and there's lots of capital and investment, most of those factories are going to be run by robots. So there's going to be some humans there, but mostly robot run.
Yeah, well, first of all, the problem with the government picking winners and losers is they just pick losers. But yeah, we don't want the government, getting involved. But the factories aren't going to come back. How are they going to come back? They're not going to sprout out of the ground. And you can't just have a factory. You have to have all the supply chains to feed it. And you have to have the resources. And then you have to have the labor that knows what to do. It's going to take many, many years to rebuild what's gone. And where is the money going to come from to pay for it all? What are we going to stop doing so we can rebuild these factories? And what are we going to do in the meantime between now and the time they're ready? And with the government running massive deficits, right? The deficits now are like $2.5 trillion a year, but they're about to blow up to $4 or $5 trillion a year because A, we're going to be in a recession, but B, interest on the national debt is going to be maybe up to $2 trillion by next year, $3 trillion by the year after that. I mean, our biggest expense is going to be interest on what we've already borrowed. So how is America going to finance the enormity of government debt and finance the reindustrialization of the country? I mean, those things are mutually exclusive. We either finance the government or we finance the economy, right? We don't have the money to do both. So look, this is a massive, massive day of reckoning that is long overdue. And because, we've kicked the can down the road so long, it's going to be so much worse than what it would have been had it happened 10 years ago.
It sounds like the best case scenario is more stagflation and currency debasement, because it sounds like the Federal Reserve is going to expand its balance sheet again, whether that's to bail out banks or bail out commercial real estate, or they're going to have to subsidize government budget deficits for these infrastructure projects to build the infrastructure out for the factory. Sounds like that's the case.
But it won't work because the government subsidy by inflation will just keep increasing the cost of the infrastructure and the raw materials. So no matter how much money we print, it won't be enough because the prices will keep going up. So then we got to print more and then the price goes up more. But yeah, the question is, how much time will this next round of QE buy us? Before, it's the QE that destroys us. You live by QE, you die by QE. And that's ultimately death by hyperinflation.
Well, the other major issue here is that for decades you had China, Japan, other major trade partners of the U.S. They were doing vendor financing, as you described earlier in the interview. They would take those trade surpluses and recycle those trade surpluses, their foreign exchange reserves, back into the U.S. Treasury market, and those days seem to be over now.
Oh yeah, I mean they've been over for a long time. But hold on.
Now, I want to talk about investment strategy and playing defense. Do you think that the system, will they actually allow a deflation? Will they allow asset prices to fall? Will they allow bond yields to spike? Or are we going to just start seeing more lever pulling, similar to bad policy decisions from the 1920s and 30s again with Herbert Hoover, FDR, and those types?
Well, they can't stop the deflation in terms of real money. So gold is almost $3,200 an ounce. What does that tell you? Prices are crashing in terms of gold. Everything is getting cheaper, even silver. You could buy 100 ounces of silver with 1 ounce of gold. Silver has never been this cheap. Oil has never been this cheap in terms of real money, except for like 1 week during COVID, which doesn't count, when it went negative. But during normal times, oil has never been this cheap. Stocks are crashing in terms of gold. Somebody else posted on X today that now, if in 1998, if you just bought 1 ounce of gold, you outperformed Berkshire Hathaway stock, but just sitting on 1 ounce of gold. So the best investor of all of us in portfolio, Warren Buffett, right, the Oracle, he didn't even beat an ounce of gold as of right now. And he owned income producing stocks. Gold just sits there. So what that tells you is everything is crashing in terms of gold. And that's going to continue. They can't stop that. But they can stop the deflation in terms of paper money because they can just print an endless supply of that. They can't print gold. So we're going to have runaway inflation that may turn into hyperinflation in terms of fiat money, but we're going to have massive deflation in terms of real money.
It's kind of ridiculous because the U.S. federal government, what they brought in almost a record amount of tax receipts, almost $5 trillion, I think, of record tax receipts. But here we are, the government's so desperate at this point, they're looking for additional sources of tax revenue. So it's definitely a DC spending problem. I do not think it's a tax problem, although they're making it us to believe that it's a tax problem. It's a spending problem.
Right. Although they're also saying that we can tax the rest of the world. Instead of taxing Americans who are already overtaxed, we can finance our government by taxing the rest of the world. Well, we can't do that. Tariffs don't tax the world.
Well, Trump is selling us. Well, Trump is selling. Isn't Trump's trying to sell voters, right? That these tariffs are on foreigners, but then the U.S. customer, the small business owner, the U.S. consumer is going to end up paying for it with shrinkflation or higher prices.
Of course. There's no other way to get the money. I mean, Trump thinks, well, the foreigners are going to eat the tariffs. Well, look, first of all, the tariffs on China are now 145%. Do you think the Chinese are going to eat that? I mean, a lot of the stuff they're selling us, their profit margins maybe are 10%. So they're not going to lose a fortune to sell us stuff. They'll sell it to somebody else or they'll consume it themselves. They're not idiots. Apparently, we got idiots in the White House, but we don't have them in China.
Well, or it's just going to escalate. There's going to be more financial warfare. So there might not be kinetic war or physical war, but I mean, it looks like there's financial warfare. Someone looks like they were selling a lot of US Treasury bonds earlier this week.
Well, they're going to keep selling them. There's a lot of Treasury bonds to sell, and we're going to keep issuing them. That's the problem. We're adding supply to a market that has no demand. So bond prices are going to keep falling. I mean, interest rates are still really low. We still have a 4 handle on a 10-year and a 30-year. Wait till there's a 6 handle, a 7 handle, a 10 handle.
Now, Peter, I keep hearing a lot of macro experts predicting that people are going to liquidate their gold, sell their gold to pay margin calls, pay their bills, other types of things. But it looks like people are selling Bitcoin, that there's a sell-off in Bitcoin. Do you think that people are going to be selling their gold for cash to pay off their debt or pay off margin calls?
Well, most people don't have any gold to sell. But to the extent that some people have gold and tech stocks or something, and they're on margin, yeah, they might sell some gold, but it's not going to make the gold market go down because the central banks are going to keep buying it. And they're not on leverage, so they're not going to get margin calls. But the public really doesn't own much gold. They've been selling their gold for years. They hardly have any. And they've been selling gold stocks for years. They don't have any of those either. So I think they're going to sell stocks to cover their margin calls. Now, most of the Bitcoin isn't held on margin, but I think a lot of the people that own Bitcoin are going to have to sell it to pay their cost of living. The people that have been holding their Bitcoin for all these years are going to need to sell it because they're going to need to pay their rent. They're going to need food. And if all they got is Bitcoin, the grocery store doesn't want your Bitcoin, so you got to sell it. But there are people that are leveraged. I think you're going to have a run on these ETFs. So I think Bitcoin is going to implode. It's just going to collapse. It's going to probably crash more than anything. So,
yeah, I would agree that I don't think we're going to see as much liquidation in gold because I think the buyers of gold are stronger hands. So they're the non-G7 central banks the major macro trade, Peter, that I've been saying for the last 12 to 18 months, especially post-Russia sanctions, is that a lot of these central banks have just decided we're not buying a lot more U.S. Treasuries or any U.S. Treasuries net buyers, that they're buying gold tonnage. So really post-Russia sanctions, the amount of monthly gold purchases has about doubled.
Yeah, and it's just going to get more. I mean, they were already buying gold before we started this trade war. And so now the appetite for gold has grown exponentially. Gold's going to hit $3,500 an ounce, I would say, within the next month, maybe. And I think it could easily top 4,000 this year, maybe 5,000, but we're just getting started. Gold's going a lot. Gold is going to equal the Dow or pretty close to it. So the Dow is barely below 40,000. I don't know where the two are going to meet. Maybe at 20,000, but they're going to meet somewhere,
Well, also the institutional investors, the majority pension funds and institutional investors do not even own 1 or 2% assets under management exposure to any type of gold or gold stocks. So if they just added, so these are tens of billions or hundreds of billions of dollars, if they added 1% or 2% assets under management, and I'm hearing they're calling up these gold companies, they're asking for how they add gold exposure. So I think we're going to start to see that in the not too distant future.
Yeah. And, I've been, in the gold business for a long time. I have a gold company. And for the first time in my career, I'm telling people not to buy gold because I think that the mining stocks are so damn cheap that you don't want to buy gold above the ground when you can get it below ground at the cheapest it's ever been. I mean, you buy gold now, you're paying $3,200 an ounce. Yes, it's going to go up. But if you buy the gold stocks, they're priced for gold at $1,500 an ounce. They haven't factored in any of this, even though they're at 52-week highs. Those 52-week highs are miles below their 3-year highs, 5-year highs, 10-year highs, 20-year highs, most of them. So you have a once-in-a-lifetime opportunity. I think that gold stocks are going to catch up. So the next maybe 50% move up in the price of gold, I think will give you at least a 500% move up in gold stocks. So it's 10-1, at least, I think. So with that kind of upside, if you've sat on the sidelines all these years, right? I've been telling people to buy gold since it was under $300 an ounce. So it's more than 10x. If you've sat on the sidelines and you haven't bought any gold, the way to catch up is not to buy the gold now, buy the mining stocks. And after you get your first triple, maybe sell some of that and then buy some gold. Even though the gold will have gone up, I think your gold stocks would have gone up a lot more. I just came out with a special report that you can download for free on my website at Europac.com, the best way to buy gold. And I make a strong case. I show you with the numbers why gold stocks have never been this cheap. They're not going to stay cheap for long, I don't think. So you need to buy it. I've got a fund. People can buy it no load, EPGIX, Euro Pacific Gold Fund. You can buy it at Schwab, Fidelity, any of these no load. That's the no load ticker. You just buy it. If you don't have a brokerage account, you can go to my website at Europac.com and just buy my mutual fund right there. We got a great portfolio. Some of these junior stocks, I think there's some stocks that we own that could go up 50, 100x. Now, yeah, it's risky, right? You can lose money in the mining business, but I've never seen a situation where the upside was so asymmetric. You have the potential to make so much money in these stocks that the risk is worth it. And it makes no sense to me that if you understand this, to buy physical gold, even though I sell it. I'm telling people, don't buy it now, wait, right? Because this opportunity is so great in the mining stocks that you can't pass it up. You still own gold when you go buy a miner because the miners own the gold and their business is extracting it and selling it. And the central banks are going to buy it as fast as they can mine it. And when the public starts to buy it in competition with the central banks, and meanwhile, oil has never been this cheap in terms of gold. Oil's at a record low. And what's the biggest cost of a mining company? Energy. So their biggest input is going down, yet what they sell is going straight up. Their profits are going to explode. I mean, Q1 earnings are already going to be great, but Q2 are going to be off the charts, I think. So you got to get in front of that and load up on gold stocks. I even bought more gold stocks myself 2 days ago, even though they're already 50% of my portfolio. But they sold them off to such ridiculous levels, I couldn't help it. I wasn't planning on buying more. But you know what? If they're going to give me a gift like that, I got to take it. But if I didn't own any gold stocks, that's all I'd be buying right now. And so that's why I'm telling people this is like a almost a once in a life. If you didn't buy Bitcoin at $100, $200, here's what you can buy to have that kind of potential. And if you still own your Bitcoin, get rid of it now and buy these gold stocks. You want to go to the moon? Gold stocks, so it'll take you there. Because Bitcoin's coming crashing back down to earth.
Unless the Fed does an insane amount of QE, but then that might boost all asset prices, and then we could see gold at $5,000 an ounce or more.
It'll boost gold more than anything. If they do that, gold's got the most to gain, which means gold stocks are still your best bet.
Yeah, we could see if the Fed reverses the balance sheet and say takes the balance sheet up to $10 trillion or more very quickly, some type of bailout or something.
They're going to have to go to 20. 30. 10's not going to cut it.
Yeah, I mean, we could be looking at gold at $5,000 an ounce very quickly. It could be Bitcoin could turn around pretty quickly. We could see all these assets just get inflated, similar to
Bitcoin is a wild card, right? People might rush to it or they might flee from it. I mean, right now it's correlated to risk assets. So if they print enough money and they get the NASDAQ going up, then maybe Bitcoin will go up with it. But, you never know because Bitcoin's nothing. At least tech companies, there's a real business there. Some of them have a lot of earnings. But all of them at least have revenue. Bitcoin has nothing. It's got no use case and it's got no earnings. So it's just digital nothing. And so, yeah, as long as people are dumb enough to buy it, the price could go up. But you can't always count on the greater fool. Eventually you run out of those.
Yeah, I'm not in the all-in Bitcoin or all-in gold camp. I'm more about diversification. I do own some Bitcoin and I own a lot of gold and gold stocks, silver as well. I want to talk about GDX, the gold miners ETF. So that's like at 47.17 right now. I mean, that's way off, 35% off its all-time high back in 2011. I think the all-time high when gold was at 2000 in 2011 was around $65 a share for one share of the gold miners ETF. So we're substantially way off the all-time high for the gold miners ETF, and that's the gold price is way higher. So the free cash flow.
But if you look at the GDXJ, which has some mid-tier companies and some smaller companies, that's at 58 today. It's a 52-week high, but it was 160 in 2011 when gold topped out at 1900. So that has to triple to get back to where it was in 2011. Now, they've issued a lot of stocks since then and their costs have gone up. So it's not exactly the same as it was back then. But these stocks are very, very cheap and nobody owns them. And interestingly enough, I didn't get the statistics this quarter, but in the first quarter, even though gold stocks were up better than 20%, maybe 25% on the quarter, GDX had only one day of inflows. Every other day of a huge bull market, retail investors were selling GDX, not buying. Imagine that. And, my gold fund had record outflows in the fourth quarter of last year. In fact, all of my funds had record outflows, and I'm crushing it. Like even my dividend payer fund, my value fund, is up about, 14% this year. In a down market, but I had all these people taking money out of my funds at the end of last year, right ahead of the best quarter we've had. The public is a great contrarian indicator. And they're a great contrarian indicator for gold and gold mining stocks because they've been selling the whole time. So they're going to eventually start buying, but at much, much higher prices.
Yeah, I agree. I think the retail investors were mostly buying Bitcoin and Mag 7 and NVIDIA. They were chasing whatever fad in the stock market, tech-wise or crypto-wise, was going up. And they had no interest in gold stocks. And
talk about government picking winners and losers. They picked Bitcoin. They established a Bitcoin strategic reserve. So what does that tell you, right? They picked the loser. And all the people bought Bitcoin based on the government buying it, right? That's why a lot of people bought it, because the government was going to buy it, right? Right. And
but now it's crashing. I don't think they added. I think that was the Bitcoin strategic reserve. Didn't they just move the Bitcoin around? They didn't actually buy anymore. That was just the Bitcoin that they had already confiscated.
Right. But the public bought on the hype that the government was going to have a strategic reserve. Wow. And all the crypto companies have been running commercials. Hey, buy Bitcoin because now we have a strategic Bitcoin reserve. The government has adopted Bitcoin. Trump is going to make the U.S. the Bitcoin superpower of the world. So they're using Trump and his creation of a Bitcoin strategic reserve to market Bitcoin, to hype up, pump up Bitcoin so the insiders can sell it. The people who donated to Trump's campaign are cashing in by selling their Bitcoin to the public. And they're using this strategic reserve as a marketing ploy. That's what's been going on.
They're doing worse than that, Peter. They're off the popularity of Bitcoin. They're like doing pump and dump with these meme coins that are even worse than they're worse than NFTs and stuff. These meme coins.
Yeah, well, Trump's got it going with Trump coin and Melania coin.
I mean, there's so much corruption in the government, Peter, from both political parties. I mean, like with the shell companies and the charity fraud, the stuff with the USAID. I mean, I've known about that stuff for many, many years and warning people. No one cared for so long.
Oh, yeah. Well, we're look, the chickens are coming home to roost. And, I'm out there just trying to get the truth out there like I was in 2008. except I'm not on the mainstream media much anymore because they stopped inviting me on. What, once I proved I could predict a crisis, they didn't want me on.
You think they'd want you on with gold at $3,000 an ounce?
No, they haven't had me on in years. And I think one of the reasons is the Bitcoin guys that buy all the ads probably said, look, we'll keep buying ads on your network, but don't let Peter Schiff come on. Because they know I'm going to talk negatively about it. Because they're just infomercials. CNBC is a crypto infomercial. I mean, all they do is talk about Bitcoin and crypto. They don't barely mention gold. And all their ads, stocks. You turn it on. Every other ad is crypto.
I think I've seen GLD ads on Fox Business. I think I've seen quite a few of those.
But they're crypto too, just not as bad as CNBC.
Yeah, CNBC pumps a ton of stocks. So whatever sector, whatever tech sector is going up, they want to pump. I think you have a very important point, though, about the gold industry. One thing I've really noticed, Peter, the last 18 to 24 months, the main drivers of the gold price, the demand side, it's been like non-G7 central banks, retail investor demand of Asia for physical metal, for coins and bars and jewelry. And now I think we're going to start to see institutional investors start to allocate. I think that's going to be the next demand area that increases.
Yeah, I mean, when we get real investor demand, then $100 a day moves in gold are going to be commonplace. I mean, we've just had 2 in a row, basically. But, we're going to have bigger moves. Gold will move up $200 in one day. And the dollar is going to keep falling. So gold wasn't up nearly as much. In fact, it might have been down. It was down in terms of the Swiss franc because gold was up 3% today, but the Swiss franc was up 4%. So gold actually got a little cheaper if you happen to have Swiss francs.
Well, all these currencies are having problems because the Japanese yen started having problems, 18 months ago? They had to sell their US Treasuries, and I think the gold price in Japanese yen has gone basically parabolic for the last couple of years.
Yeah, but now the yen is rising. It was as low as 160, and now it's back to 144 and a half. I mean, I think the dollar is going much, much lower. So the dollar index is about 101, right? Let me see where it closed today. Did it close below 101? Let me see. We closed at 100.97. So right about 101. Once it cracks 100, I think it's going to be a quick move to 90. That's a 10% drop in the dollar. And if you remember, all these experts were predicting that the tariffs would strengthen the dollar. And they thought that would help take the sting out of the tariff because, the dollar would go up, so imports would get cheaper because of the strong dollar. I was the only guy saying that tariffs are going to weaken the dollar, and that's exactly what's happened. And so if the dollar drops, let's say 15%, from Liberation Day, that adds 15% to the cost of our imports. Now add a tariff on top of that, and a 10% tariff costs Americans 25%. So think about that.
Well, I think also with the VIX where it is, Peter, I think we're going to start to see margin calls from these hedge funds and portfolio managers of banks that were doing these over-leveraged bond trades, the leverage short volatility trade, all these types of over-leveraged trades. The Fed's going to have to do a bailout at some point. Unfortunately, this is the Ponzi scheme system post-2008 that has been developing for many decades thanks to the abuse of the world's reserve currency.
And we're very close to some bank failures again, because all these credit defaults and bankruptcies and margin calls are going to produce runs on banks. And so the banks don't have the balance sheets. And just like, the Fed did about $250 billion of QE in the month that Silicon Valley Bank and Signature Bank and those banks failed, they're going to have to do a much bigger round of QE.
They've been talking about hedge fund bailouts too. So I think it's commercial real estate. So you have the regional banks, and then you also have like the hedge funds. Now I've seen rumors floating around talking about hedge fund bailouts. I mean, these are like the large hedge funds. So we're talking like Ken Griffin at Citadel and Ray Dalio at Bridgewater, those guys, because they were the ones with hundreds of billions of dollars in assets under management putting on these really stupid over leverage trades.
Yeah, look, as I said, he opened up a can of worms. We're a highly leveraged economy, and we just basically shot our bankers, our lenders, and said, hey, you guys are taking advantage of us. Stop loaning us all this money. Stop supplying us with all these goods that make our whole economy work. Like, we want to be liberated from that. That's what I said at the time. When he was saying Liberation Day, I said, okay, you're going to liberate Americans from all the inexpensive goods that we've been buying. You're going to liberate us from all the low interest rates, and you're going to liberate us from the value of our stock portfolios, the unrealized gains, right? All that's going to be gone, right? That's what was liberated.
Well, the history of tariffs and trade wars escalating, resource wars with countries restricting exports, and then neo-mercantilism. I mean, the history does not bode well for lower prices and lower inflation. It normally creates even more of a mess and more chaos.
Oh yeah, I mean, as I said, when Ben Bernanke, like even not Ben Bernanke, when Jerome Powell, like about a year ago, at a conference, somebody asked him, well, people are talking about stagflation. And he said, well, I don't know why people are talking about that. I see no evidence of no evidence of inflation. And he started laughing. And I said that statement will go down right alongside of subprime is contained and inflation is transitory. And I called out the Fed on both those statements. And I immediately told my audience, my podcast and on X, that he was blind if he didn't see the stagflation. That was everywhere. So the Fed is always oblivious to a problem until it becomes a crisis. And then only after it's a crisis, then they react. But they always pretend that nothing is wrong right up until everything hits the fan. And then they come with printing money and QE. And so that's going to happen.
Oh, yeah, I agree. We'll see a panic move. The Fed will do a 180. So I don't know if it's going to be Fed rate cuts or it's going to be balance sheet expansion or a combination of the two. We will see those at some point because unfortunately, post 2008, this is the type of system that we have where anytime like the stock market falls or something like that, an asset price crash, the Fed just panics to save the banks or to save the asset markets.
Oh, yeah. I mean, but the thing is, it may not work this time because, if there's a run on the dollar, printing more dollars just fuels the fire, right? So, we could end up, people made fun of me because I talked about hyperinflation before, with QE. And I never said it was a sure thing. I said it was a worst case scenario. But we faced the risk of that. But we were able to find demand for the paper. We were able to print all that money and the world absorbed it. But they won't, I don't think they're going to absorb it this time. So this time we might get the hyperinflation that we avoided the last time.
Well, when the national debt was smaller, Peter, and you're running $1 trillion budget deficits, it's not quite as bad. But when you do it for 15 or 20 years of $1 trillion base case budget deficits, and then they expand the budget deficits way above $1 trillion, and then the interest payments on the national debt are $1 trillion, then you start talking $2-3 trillion per year, and that starts compounding it even faster to the point where basically you have no good options left. And I think, unfortunately, this is where the people in D.C. at the Treasury and the Fed find themselves.
Meanwhile, and the Fed officials, all they would say is we're on an unsustainable path. So we don't have to worry about it because the debt isn't unsustainable. It's just a path. And I would say if the path is unsustainable, so is the debt because that's the path we're on. And how do you know when the path ends, right? If you're going to say, oh, we're not worried. Janet Yellen once said, well, we don't have to worry about the debt as long as interest rates are low. And I said, yeah, what happens when they're not low? But the point is not to wait until interest rates are high and you can't afford it. It's to do something about it while they're still low. But we didn't do anything about it except take on more debt.
Yeah, they did the opposite. I mean, they did insane amounts of spending programs that were wasteful. The money was not invested. You ran for Congress, Peter. You know that when Congress was trying to do these infrastructure bills, that most of the money didn't even go to infrastructure.
And here's the worst part about it. Over the next 4 years, of the 37 trillion in debt we have, 26 trillion of it matures over the next 4 years, right? So we got to roll that debt over. We got to find new buyers for that debt. In addition, we're going to borrow at least another 10, more like 15 trillion in new borrowing. So you're talking about maybe $40 trillion, 35, 40 trillion that we have to borrow over the next 4 years. Where's that money going to come from? The Fed is going to have to print all that money, right? And then what happens when the balance sheet goes that? So we have reached the end of the game, right? All the people say, oh, this is a problem for our grandkids. No, it's a problem for us right now. Our grandkids will read about it in the history books. We're living through the day of reckoning, and it's already started. And I remember, when I was on Fox and CNBC and CNN, all this stuff, in mid-2008, talking about this huge recession that was coming, everybody was saying, nothing to worry about, everything is great, even though we were already in the recession, because they went backwards and they backdated it a year later. So at the end of 2008, they went back and said, hey, we've been in a recession for the last year. Even though
you had people
all the numbers
arguing
said everything was great.
Didn't you have people arguing with you on TV all the time saying that home prices nationally have never gone down? They kept repeating that like all the time on your interviews, though.
Yeah, that's why a lot of people didn't want to get into my hedge fund to short subprime, because it was predicated on housing prices going down, which people thought was impossible. And I would tell people, look how much housing prices just went up. That's unprecedented too. You can't tell me that we're at some permanently high plateau, that something that goes way up can't go down just because it hasn't happened. It never went like that either. But, they're oblivious. But this is an even more obvious. I thought the financial crisis was obvious. This is even more obvious. But the same people that were oblivious to that can't see this either.
And normally what US Treasury bonds are considered the safe haven, but it looks like this time there's going to be a huge sovereign debt crisis in the Treasury bond market, as you laid out, with interest payments on the debt. Pretty much no matter what policy Congress or the White House does, the budget deficits and the size of the national debt is going to keep growing. So basically now it's just a math problem, and there's not a ton of stuff they could do. I mean, they could cut government spending dramatically and the debt would probably still grow.
Yeah, I mean, treasuries are the new subprime, and there's no bailouts for that. I mean, the only ones that could have bailed us out were like China and Japan, we've already, burned that bridge, certainly with China.
Yeah, I mean, I don't think China is going to be buying any more U.S. treasuries.
No, they're just going to be selling. And it's not just treasuries. They own a lot of corporate debt in dollars. They're going to be selling everything.
Well, what a mess. I'm glad I have gold and gold stock exposure. I think in 18 months, maybe even less than that, Peter, we see $3,500 an ounce gold. I mean, we could see way higher than that.
18 months? This month.
Oh, you want to go on record here? You think we see 3,500 in the next 30 days?
We're up $200. We're up $200 in the last 2 days. Thinking we're only $300 away.
That would be quite remarkable. I mean, maybe then some of the pension funds and institutional investors would start to allocate to gold, because if we get some exposure to the gold stocks, some of these gold stocks could double in a couple months.
Triple, quadruple. But, Jim Cramer came out the other day and said gold's too expensive. Don't buy it. That was great. And every time somebody mentions CNBC on gold, they say, well, it's a crowded trade. Too many people have it. It's kind of late to buy it. Crowded. No one that watches that network but me owns it. And I only watch it so I know all the bullshit that they're talking about, so I can comment on how dumb they are. It's the only reason I watch it. I get a lot of material.
Well, as I said earlier, I think the main macro theme, Peter, of the last 12 to 18 months, and it's only been accelerating as far as I see from policies out of DC, is that there's a huge problem in Treasury. So I don't see the normal safe haven bond market rally that would have happened in the past if people were worried about deflation or bankruptcy or other assets falling. Because like if the stock market crashed, normally what Treasuries would have a rally, the bond market would be going to some type of yields would fall and it would be a bull market. But I see that like a lot of foreign demand for physical gold, whether that's Asian retail investors or G7 central banks. So I think the macro trade is that the foreigners are deciding we are not going into Treasuries. They are buying gold instead.
Yeah, well, they've been doing it. And I've been saying, it's like insider selling. The insiders of the fiat monetary system have been dumping their fiat. They've been dumping their dollars and buying gold. And they've had the advantage of no competition from the investing public. But that's going to change. So you're going to have a lot more buyers. And, the supply of gold is pretty limited. And these gold companies are going to have to ramp up production because there's going to be so much demand. But it's going to take a long time for them to ramp it up. So the prices are going to keep going up. And one of the things that's going to happen in the gold mining sector is consolidation. You're going to see more mergers. And you're going to see gold companies, instead of taking their profits and trying to build out more capacity, they're just going to buy back their own stock because it's still so cheap.
Oh, yeah, or increase dividends. So a combination of those things. I mean, if you have a lot of free cash flow, you can, if you think your stock is cheap, you can buy back your stock, or you can increase dividends. You can go and invest into growth. So hopefully all those things.
Yep.
Well, Peter, I really enjoyed our discussion today. It's just wild, all the stuff going on. So many policy mistakes in the 1920s and 1930s with the trade wars, the tariffs, neo-mercantilism, basically all the Keynesian lever pulling and central planning mistakes that we saw back then. A lot of the stuff seems to be repeating, unfortunately.
Yeah, it is repeating, and it was extremely predictable. I've been warning about it for a long time, so it's not like, this is coming out of left field. If you understand economics, which hardly anybody in the White House does or on the major financial networks, all this stuff is easy to understand and easy to predict. I mean, a lot of these guys have higher IQs than I do, but they don't just get how economics work. And I understand it because I've known it my whole life. I was educated by my father, and so my mind thinks clearly, and I'm able to, connect the dots and see the unintended consequences of everything the government does.
Well, I would also add
final conclusion.
I would also add, Peter, that these academic economists and the government economists, I mean, their bias is to make sure that the government gets more power. So they don't take responsibility that, we screwed this up. Oh, maybe we shouldn't be doing these types of policies. They tend to blame it on other people and then give themselves even more power and even more policy decisions.
Yeah, just like they blamed the financial crisis. After the 2008 financial crisis, they had hearings on, why we had the crisis. And I was trying to get invited because, I predicted it. I wrote a whole book predicting it, but they wouldn't invite me. The only people they invited were the people that were blindsided by the crisis. And every single one of them blamed capitalism. Not enough regulation, right? Too much greed. We need more government oversight, right? The exact opposite of what we needed. Government created the problem. The Federal Reserve and the government, their moral hazard, their subsidies, their artificially low interest rates, they inflated the bubble and then it popped. It had nothing to do with the failure of capitalism. It's the failure of government to allow capitalism.
Yes, and government corruption, because I mean, like a lot of these regulators, we find out with the stuff with Doge and USAID stuff. I mean, a lot of them were collecting six-figure paychecks, and some of them weren't even going into work at all.
Yep.
Well,
but anyway, I would say, look, just keep listening to my podcasts. You want to know the truth, you got to listen to my podcasts. You got to read my posts on X. I'm posting all day on what's going on, because you can't get your news from the mainstream media. If you go to the left, you go to CBS or CNN or MSNBC, you get all Democrat propaganda. You go to Fox or Newsmax, you get all right-wing Republican propaganda. It's either the never Trumpers, and Trump can't do anything right, and he's Hitler, to Trump is a god and he can't do anything wrong. And there's like no in between. And so I know what's going on. I call a spade a spade. I criticize both parties when they make mistakes, even though I have more in common with the Republicans than the Democrats. And I endorse Trump as a candidate. I also warned that this was going to happen. So it's not like I'm surprised.
Well, you ran as a Republican, right, for senator in Connecticut, right? Yeah. But that's because like there's only a two-party system with the corruption, right? So you have to go through either political party machine, and they basically both political parties have sabotaged it, so there's no viable third party.
Yeah, but right now the Republicans are saying so much dumb stuff that they actually found a way to make the Democrats look smart.
Well, this is the problem with central planning and Keynesian economics, right? So you start getting into pulling all these levers and protectionism and tariffs and mercantilism. Both political parties, whether it was Herbert Hoover or FDR, they were, as you said earlier, FDR mostly lied to get elected, right? He said he was going to cut all the government spending, and he just doubled down on Herbert Hoover's policies. Yeah.
All right. Again, so just follow me, listen to the podcast, go to Europac.com, download my free report today on the best way to buy gold to understand the incredible opportunity in these mining stocks. And I wrote that report about a week ago, and I finally got it up yesterday. I mean, people have really got to start, getting invested and getting, all foreign stocks. Look, as all this inflation moves back out of Wall Street, back to Main Street, and you have this massive de-dollarization, the U.S. market's going to collapse relative to the rest of the world. So our asset prices go up, foreign asset prices go down. The U.S. stock market was the only game in town for the last 10, 20 years. Now it's going to be a disaster. You're going to lose a fortune if you go down with this ship. So you got to get out of U.S. assets, U.S. stocks, U.S. bonds, and get into foreign stocks, emerging markets, commodities, mining stocks. This is what's going to work for the rest of this decade. And you got to make this shift quickly. People lost a fortune in the 1970s holding on to their nifty 50 portfolios, with the Polaroid and Xerox and all those, one decision stocks that got killed. Meanwhile, they could have made a fortune in gold, in oil, in Japanese stocks, stuff like that. But, they weren't thinking. They were still wedded in the past. You got to forget about that and look forward to the future. And I am positioned for the future right now. And I, would encourage more and more people to join me and get into these portfolios now. And we can help you at Europe Pacific Asset Management.
And the 1970s stagflation, all with Paul Volcker raising interest rates, also had the worst U.S. Treasury bear market besides the last 3 years. Treasuries back then were called certificates of confiscation. With the policies we see implemented, Peter, we could see yield curve control and a bring back of the certificates of confiscation.
Well, because the problem is now we can't do what Paul Volcker did because we can't afford it. If we moved interest rates up to 20% and we have a 40 trillion national debt, that's 8 trillion in interest. I mean, so it doesn't work anymore. We no longer have the medicine to cure us because the medicine will kill us.
Well, also all the older treasury bonds, when they raise interest rates, they're destroyed the value. So, I mean, like, they don't talk about that. So if they do raise interest rates, they would destroy the older treasury bonds too. And then the banks would be holding bad collateral. So that's just,
but a lot of the treasury bonds are short term. They mature right away. They only destroy the value of the long-term stuff. But yeah, the banks have a lot of these long-term and they destroy the value of their mortgages. You're holding a 30-year mortgage that's, got a 3.5% coupon and treasuries are 20%. You're bankrupt.
And people ask me why I own gold, silver, and gold stocks. I think you just laid out the case in the last minute.
Yeah. All right. Take care.